Okay, part two of the policy loans. We're going to look first at non-direct and direct recognition. This is a popular topic and really understanding it so we have full awareness and full transparency around how it actually works is very, very valuable. Instead of just hearing one is better than the other, so ignore the one that is potentially bad and buy this policy through me. Now let's see how it actually works here. So non-direct and direct recognition. What these terms mean is if a company does not non-direct recognition, if they do not recognize the fact that we take a loan out in respect to how they pay dividends and interest on our cash value, or if they directly recognize the fact that we take a loan out from our policy and adjust the dividend crediting rate on a life insurance policy. A lot of words in there. Let's see how it actually works. So first we're going to look at an example. Going back to the top companies we mentioned, we're going to look at an example with these two guys, Mass and Guardian. Mass Mutual offers both non-direct and direct recognition. But if you want to set the policy up with maximum flexibility, you'll be forced to take their non-direct recognition option. Now, Mass Mutual has a dividend rate presently at 6%, and their variable loan rate is 5%. So how this works specifically, and this would be the case with any non-direct recognition company, just the dividend rate will adjust a bit depending on the company. And keep in mind, that dividend, again, is not what we're earning. The net IRR is what we want to look at, which might be 4% in this example. So if I have $100,000 in cash value, I will earn or receive that 6% dividend on the full cash value. Like that's what it will grow by because I haven't touched it. If I loan $50,000, what will happen here? I will still receive the 6% dividend on the money still in cash value. And then the money I've loaned from the policy will still receive the 6% dividend rate because it is a non-direct recognition policy. What that means with this example is when I pull that $50,000 out in the form of a loan, the company does not recognize that loan in respect to their dividends. They're going to pay the same dividend on all policies that have that variable loan and non-direct recognition treatment. Doesn't matter if I have loans outstanding or not. While at the same time, I pay that 5% loan interest rate to the insurance company, in this case, Mass Mutual. So if my cash value by year 10 was going to be worth $200,000, and I took out that $50,000 loan and I paid it back by year 10, it's going to be worth $200,000. 100% restored to exactly what it would have been as if I never touched it in the first place. Next example, with direct recognition. Guardian. They presently have a dividend rate of 5.65%, which again means I want to look at what? The net IRR. This is the case with all companies, especially when I'm looking at loans. They have a fixed loan rate. Mass Mutual's was variable, but Guardian has a fixed loan rate at 6%. On paper, that is a negative spread. So would it not make sense to borrow from a Guardian policy? They are also a direct recognition company for the first 10 years at least. I'd encourage you to view our All About Guardian video. So loan rate of 6%. Here's how it works. If I don't touch the money, that $100,000, I have that dividend rate of 5.65% that I receive on the full 100. Now, if I loan out $50,000, the cost to borrow is what? 6% that goes to the insurance company. Now, here's how it will work. That dividend rate of 5.65%, oops, there we go, is credited still on the $50,000 I have not pulled from the policy, yet the $50,000 loan still receives a dividend. What Guardian does is adjust the dividend upwards to 6%. So they increase it right now, really to create, in some ways, a wash effect. Why it's not a wash effect though, is again, that's a gross dividend, going back to the net IRR, which we touched on in the last video. They increase the dividend. That's the main point here. What they want to do is prevent this negative spread on paper from making policyholders feel like they're going to be punished from borrowing from their policy, or for borrowing from their policy. If I could talk today, there we go. So, on this example, what would happen here is if I didn't touch the money, my cash value, let's say in year 10, for the sake of simplicity, was going to be worth $200,000. Now I've loaned and borrowed against it. So now, instead of that $200,000, by year 10, my cash value might be worth $206,000. A little bit more because the leveraged portion received a dividend of 35 basis points higher than the non-leveraged portion. And you'll see this. We've got several videos that demonstrate this. When I borrow and repay, everything's restored and a little bit more. So very valuable in that respect. So this one was fun, always touching on non-direct and direct recognition. Spreadsheets coming up next. Hope this one helped. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.